Welcome back to CEO Money. I'm Michael Yorba. Thanks for joining with us. I have Rebecca Walser, JD, LLM, CFP, Walser Wealth Management, and walserwealth.com. Rebecca, welcome back to the show.
So glad to be here.
We have a lot of instability in the markets right now all over the world. The markets are at a place right now that really is causing a lot of confusion. How do you help your clients deal with this instability?
I think that the first thing we have to start with, Michael, is a basic understanding of where they are in their investment horizon, because when you're in your 20s, your 30s, your 40s, we really could go through a big, substantial correction, even a 60% route. And you know what? We're going to be okay. We're going to bring that back up and we're going to buy and hold over the long term. It's a long-term investment horizon. Now, obviously, if you're actively managing money and you want to avoid the route, sort of sit on the sidelines and get back, in when the market goes, is bottomed out, that would be a preferable method. But most people that are in their 20s, 30s, and 40s are not looking at their 401ks or their IRAs or just saying, yeah, whatever, I'm retiring and much later, I'm just actively contributing some kind of dollar cost averaging scenario. And they're not really actively saying move to cash, move out. They're not market timing, as you know. But the problem is when you start to get into your 50s, when you're 10 years out from retirement or less, we start to look at the mathematical impact of volatility. And it is just a no-brainer. It is a no-win proposition. A lot of advisors, I deal with these people all the time. My clients come to me coming from a traditional advisor that gives them the buy and hold. The market goes up, the market goes down, it's cyclical. Don't worry, it'll come back. You don't need this money right now. You haven't retired yet, blah, blah, blah. And I don't look at it that way at all. Because what I look at from a mathematical perspective, I'm very economical. I like to break everything down to mathematics. What I look at is the history of all of the recessions we've had going back to the Great Depression. And what we see, Michael, if you go through the correction, you're going to lose 4 to 6 years on the recovery time. So if I'm 10 years out from retirement and I've just gone through the Great Recession that we had in 2008, it takes me 4.5 years just to get back to what I had pre-correction. And if I only have 10 years left, I've just lost 40% of my time or more to getting back to where I was. As we are just running on the little rat reel for all of that time. And frankly, who has time for that? When you're 10 years out from retirement, we need every minute we can use to grow the money and not just get back the money.
I agree. Solution?
The solution is, unfortunately, you have to become a market timer. You have to say, I cannot afford to go through this next correction. You're calling up your guy at the brokerage house, and he's been trained with the same advice to give you to just stay the course. Don't make an emotional decision. This is a long-term strategy, and he's going to try to convince you to stay.
Right.
And I'm not trying to impugn his character, but the truth is if you move to cash and you're not actively being managed, that's how they make their money, and that's just the fact. The truth is, if we move to cash, it mathematically is better for us to avoid the correction than it is to go through it, even if we're not making a return. I've looked at the last 20 years, 1998 through 2017, that we have of market-based returns. And the truth is, if you simply eliminate the losses, even if you only get half of the upside, you actually outperform the S&P 500. You eliminate loss and you get half the upside, and you actually will outperform the market. So what this tells us, Michael, is that it is the losses when we get to retirement that kill us. It is the volatility towards and in retirement that are their wealth destroyers.
Yeah, you're not going to get the major wirehouses talking about it like that. It's not going to happen.
No, and I understand they can't afford to do it, and it's fine. But let's just be real about it. Like if your client goes through and loses 50% in this next recession that we're on the verge of, that we're teetering with, I think it could be at the start of the next correction at this point, and your client loses 50%. And this is the one part that conventional advisors and brokerage houses don't tell people, which makes me mad. They tell you buy and hold, long-term strategies, cyclical, come back, right? But what they don't tell you is that you're trapped. And that is very important for people to understand, because if your portfolio has gone down 50% and you're pre-retirement or even in retirement, you cannot now touch that money for the next 4.5 or 5 years it takes to get back to where you were. If you touch money, if you take a distribution, you've just taken a distribution from a down portfolio and you've forever locked in a loss. You have forever locked in that loss because you've taken the dollars out and you inherited an opportunity cost to never have that money that was in regrow to what it was previously. So you are trapped. If you want your money to grow back within the time that you can allow it to, you cannot touch your money for that 4.5 years. So if you're in retirement and you're not getting but Social Security and you have to supplement Social Security with what you're taking out of a portfolio and your portfolio goes down, where was the advisor telling you? But just so you know, if you lose 50% and you need to get out this cash flow every year, you're not going to be able to do that because you need to let your portfolio breathe for the next 4.5, 5 years while it recovers from the loss that we just had. They don't tell people that, and that's what really makes me so mad.
Well, Rebecca, I wholeheartedly agree with you. I'm a market timer from way back, and I disagree with you only on one point, is that those wirehouses do have the knowledge, they do have the vehicles, but it's just easier to go along with the crowd and say, no, it's a long-term strategy, just sit, wait, and hold. It's always worked. Well, sometimes it doesn't. And when it doesn't, that's the part where you see massive losses and people panic at the bottom, and that's when they do this. They have to start taking those distributions. I agree with you 100% on everything. Thank you for being here on today's show.
Thank you, Michael.
You're welcome. All right, you've been watching CEO Money with Michael Yorba. Thanks for joining with us. Like us on Facebook, follow us on Twitter, and subscribe to our YouTube channel.